Hey guys, often traders are confused and they're not sure whether they should sell a put or buy some shares and sell a covered call. And someone asked me on my channel recently, which one's better, which one makes more money. So I'm gonna break it down really easy for you guys in this video. If you like the video, click the subscribe button. That way you'll be sure not to miss any future videos. And also, if you wanna hear about a certain topic, put a comment in the video here and let me know what you want me to talk about next. Now, in the meantime, let's talk about the differences between selling a put and selling a covered call. One of the big differences between the two is that when you sell a put, you're leaving your money in cash. So when you can drive a rate of return using cash and not stock, that's always going to be a little bit more advantageous. Why? Because keeping your money in cash is way better. I mean, here's the thing, when you own shares, that's good too, and you can sell a covered call. But the disadvantage of that versus puts, selling puts, is that you'll have some volatility, some paper gains and paper losses on the stock. Whereas alternatively, if you keep your money in cash, then there's not going to be any stock volatility. So that's one of the biggest differences. Another difference between selling a put and selling a covered call is this. When you sell a put first, it's kind of like you get to double dip. Let me explain to you what I'm talking about. So you leave your money in cash, you're selling a put. What you're doing is you're taking an income and you're committing to buy 100 shares of that particular stock if it drops below a certain price. So if it doesn't drop, you don't buy the shares, right? But either way, you keep the premium, which is great. That's a definite advantage to selling a put. Now, if the price does drop and you do have to buy the shares, then you can turn around and sell a covered call. Sorry, my dog's squeaking in the background. Then you can turn around and sell a covered call, and that's what I mean by double dip, right? Because you're getting more premium, and then you're going to commit to buy the shares at a higher price if it goes more than that strike price. So all things being equal, I really prefer selling a put first. If you buy the stock, then you sell a covered call against it. However, you do want to calculate your rate of return. Really, there's a lot of factors that determine, okay, which makes more money. It's not like a black and white thing, but it's very easy to calculate rate of return. I mean, basically what you're going to do is you're just going to calculate, and you could do it with a simple calculator. I do have trading tools that I'm going to push out soon. I'm going to put a link in the video here that you can join my inner circle. That way I can send you an email once they're ready to be developed and pushed out to the public. But right now I use automated tools, spreadsheets kind of thing, to calculate. But you can also use just a basic calculator. It's not hard, and I'm going to break it down right now for you. All you're going to do is you're going to divide the premium that you're getting by the amount that you're putting up. So let's say you sell a put on, ABC stock, and you take in a premium of $100, and let's say that particular contract costs, $2,000 in margin. Let's say if you're using margin, $2,000 you have to have in order to make that trade. You divide $200 or $100 in premium, whatever your premium is. Let's say it's $100. You do 100 divided by 2,000, which is your required capital that you need to make the trade. And then that's your rate of return. But then you have to see how long you hold that trade for, right? Because really, you want to annualize things out because you want to get a sense of how much is my annualized rate of return, right? So I'm going to divide 100 divided by 2,000. That gives you your percentage rate of return. And then let's say you hold the trade for a week. You're going to divide it by a week's time, and then you're going to multiply it by 52 weeks in a year. So you can get very specific using days. That's why using a calculator is always easier, but you can get a good rule of thumb and a good approximation by just doing basic math. Like, let's say today's Friday, the market's closed now because it's nighttime, but let's say I sell a put for next week, right? I'm not going to calculate the exact number of days. I'm just going to say $100 in premium divided by $2,000 in capital needed to make that trade. That's 5%. And then I'm going to say, okay, today's Friday. I'm going to write it for next Friday. So that's 1 week. So I'm going to take that 5% and multiply by 52. So 5% multiplied by 52, that's 260%. So I'm not saying it's a guarantee or it's a black and white thing that you're going to make 260% per year. However, if you look at the mathematics like this is the magic of selling options. You can make a very, very, very high rate of return. Now, the trick is this, and this is probably like the one caveat to this. If you're using margin, now if you're not using margin and you have what we call a cash secured put, so let's say you're selling a $100 put on ABC stock and you don't want to use margin, 100 times 100 shares is $10,000. If you don't want to use margin, you have to have $10,000 in order to make that trade. Now, in my example here, let's say you take in $100 divided by $10,000, that is going to be 1%. So you're going to multiply that times 52. Now, even that is 52% per year. This is what I'm talking about, guys. A couple things, I'm going to break this down for you very simply. When you give your money, let's say to a financial advisor, or you put them in some SPY ETF or some index-based mutual funds, and you're getting 8%, 10%, even 12%, even 15, 20% per year, the fundamental problem with that strategy is this. Those are paper gains. I know I've talked about this a lot in other videos. There's a big difference between paper gains and realized gains. So paper gains, you're going to see your money fluctuate on your computer screen, right? Or your statement that you get in the mail. You can't actually spend that. When you sell options, when you trade options the way that I talk about in these videos and the way I teach people to do, you're creating yourself weekly income. So in my example, where you sell a put, let's say, and you take in $100 and the put expires next week, you keep that money no matter what. So you get paid the same day that you sell the contract, right? In a week's time, that risk is off the table. So one of two things is going to happen. Either the price is going to be higher or lower than your strike price. If you're selling a put and the price of the stock is lower than your strike price, you're going to buy the shares, right? But if it's not, if it stays higher than the strike price, you don't buy the shares and you keep the premium. You keep the premium either way. And that's realized gain. You get to spend that. So it's not like it's some fictitious number on a computer screen that you see go up and down. Why take the roller coaster ride if you don't have to? Also, how do you live from day to day, week to week, year to year? Cash flow. I mean, if you're watching this and you have a 9-to-5 job, you need cash flow to pay your bills, right? I mean, that's the name of the game. So why would anybody choose paper gains over realized gains? I'll never understand. I think the only reason why they do that is because they don't understand these concepts, and they're super easy. Tell me in the comment section, can you see yourself doing this? So getting back to my example, you could just use a simple calculator to calculate the rate of return. Now, the one caveat that I was mentioning before is margin. If you're using margin, you have to do a few more things to make sure you don't blow up your account. What do I mean by that? Here's what I mean. Let's say the margin on, let's say I have an account with $10,000 and I have a couple of put contracts, and the margin on to hold those or to sell those contracts initially was, let's say, $9,000 or $9,500, right? But my account was only $10,000. Well, as time fluctuates and as the stock price goes up and down, your margin is going to change, and that could trigger a margin call. Now, you only lose money when you sell something for less than what you paid. So the name of the game is try not to do that. Don't do that. I very rarely take a realized loss. I don't so much care about paper losses. I mean, I kind of care about it because, nobody wants to see like your account value on a computer screen that's lower than where you would like it to be, right? So I care a little bit in that regard. However, it's not as important as realized gains. I care about realized gains. How much money do I put in my pocket? Realized losses. How much money do I take out of my pocket? Look at it that way, right? And so when the price of a stock fluctuates, specifically when the price of the stock goes down, that could change the value of your account and trigger a margin call. What's a margin call? The margin call, it means that you don't have enough capital in your account to support those positions. And unless you put more money in, you have to liquidate a position. And that's what causes you to take a realized loss. Now, that's a very kind of like a much more advanced calculation to calculate margin. So I use tools that I've created for myself, mostly spreadsheets, but lately I've been spending all of my time programming. I was never a programmer, but I hired a few programmers over the past couple of years, and they never really did what I wanted them to do. So I was always kind of not too happy with the results. So recently, I would say about 3 months ago, I started programming myself because I want to automate things. Like, we live in 2025. This is the day and age of computers and AI and ChatGPT and all these amazing things. So why am I using like old school spreadsheets, right? Where I have to manually input data? No, I want to be able to just fetch the data and calculate it automatically on the fly. And so I've created for myself, and I'll be pushing these out soon, spreadsheets that calculate, okay, if I have, let's say, Tesla and Google and Apple in my account, and my account value is X dollars, I want to be able to see, use a hypothetical simulator, let's say, to see if Apple, as an example, goes down 10%. What does that do to my account? Does that trigger a margin call? That's really the ultimate thing that you want to know, is where a margin call is triggered from fluctuation in the stock. So stay tuned. If you think that's important, if you're trading on margin, I'll tell you what, guys, that's super important. You know why? Because you could be doing really well and the market's going well, but if you don't understand exactly how margin works, if you're using margin in your account, you could literally blow up your account. You could make a ton of money and then lose it all like that. Because margin amplifies your gains, but it also amplifies your losses. So if this is something that's of interest to you, having access to those tools, I'm gonna put a note here to join my inner circle. So it's free anyway, just put your email in, and then I'll be sure to let you know once that tool rolls out publicly. That's gonna be soon, so stay tuned. Anyway, going back to selling a put or selling a covered call, which one's better, which one makes more money? I would say that depends, right? So it depends on the rate of return that you calculate, like we just went over. But aside from the rate of return that you calculate, all things being equal, it's always better to drive a rate of return, keeping your money in cash. So me personally, I like to sell a put, and then if I have to buy the shares, sell a call. Anyway, I hope that helps. Be sure to subscribe to my channel. I've been putting out a video every single day for, I don't even know, the past 2 months, I think. And I'm continuing, I'm committed to continue to do that moving forward. And if you want to see a video on a certain thing, let me know in the comments section, and I'm happy to make that for you. Anyway, happy trading. Take care.